Good afternoon, everybody. Chris Lester here. I want to start with saying thank you for taking time out of your day to listen to some of the messages I've been trying to share every week in and week out. So without further ado, we'll get started. We're going to go over this week's topic. Does your retirement have a virus? And you may say, really, Chris, this is what you're going to call your presentation? But it's done with a little bit of levity, right? We're in an environment. I mean, I'm not showing my face right now just because I want us to stay focused on the content. But I do have a beard. It's 78 days of quarantine, and we see so much stuff on the news. But I just think that we have to take a breath and allow us to enjoy each other. And that we are in God's good graces on the right side of the grass. So, this is done a little jokingly, and it just allows us to correlate some past events with what we're talking about now. So in today's chat with Chris, you're going to learn a little bit about the impact of a pandemic from a financial standpoint, how to vaccinate your money and better protect your future, and how to know if you're prepared for the unknown. So this chat with Chris, does your retirement have a virus? Depending on who you are on this call, you may still be working, you may not be working, but this is for you if you're an active investor with a 401k, an IRA, or if you own stocks, bonds, or mutual funds. If you suffered some negative impact from the recent stock volatility, and I can say without a doubt, probably most people have, and you don't know what to do next or how this recent crisis will impair your future plans. So you're worried. So this is why I wanted to do this topic, is because I want to, sometimes the last couple of weeks I've maybe shared some information that has caused a little bit of an uneasiness or an anxiety. And really what I want to do here today and what I'll always try and be is sharing with you what I see. Right, I'm the messenger, but a part of my job is managing expectations and helping us to reduce our anxiety. So just keep that in mind, that it is human nature to get nervous. If you have that feeling or something doesn't look right or you have questions, right? Just understand that everything, I said this before, but everything's going to be okay. We are going to get through this. So imagine you had a magic wand. And that magic wand, we could lower your stress level. We probably would do that, right? That would, if everything was back to the way it was maybe 12 months ago, maybe your anxiety level isn't as high. So it's a lot of it's frame of mind. We get so hyper-focused on what's going on around us immediately that it's hard to take a step back and look at things a little bit more from a macro view. Then we want to answer that huge question in your mind. And this question, when I'm polling audiences, when I'm doing workshops, whether it be at Rutgers or whether it be at Raritan Valley, or if I'm in a venue where I'm polling the audience, usually if I say, what is people's fear as they head into retirement? Number one fear. And 9 times out of 10, the response I will get is, I'm afraid of running out of money in retirement. And so that's what that magic wand is. Hey, we had the ability to sort of forecast that, what would that look like? And then be prepared, right? I do workshops called prepare workshops, but I thought this was interesting in this slide deck. Be prepared for the next time, right? What we're going through right now, I can tell you, I don't have a crystal ball. I don't know exactly when, but I do know it's going to happen again. Volatility and corrections are here to stay. So the swings are uncomfortable. When the market's on a rise and we're all making money, we're high-fiving. When it resets, we get antsy, and we have to make sure that we understand that with plans in place, it's actually not a reason to panic. So a brief introduction, if you're not familiar with who I am, that's me when I did not have a beard. I'm the president of Professional Planning Services. I have approaching 30 years in the business, and I've had the great fortune of teaching and working with a lot of advisors across the country. Part of this format that I'm doing every week, and with all my advisors in the field, I'm allowing them to invite their clients onto the call, just in a spirit of being able to share and educate. And then if that advisor who invited you to the call you have questions, please direct your questions back to them. So before we begin, I'm just going to share with you this article, the Wall Street Journal, Economic Fears Hit Global Markets. Well, what's interesting there is that when you look at the date of this article, it's actually from August 3rd, 2011. And one of the things that we've gone over the last couple of weeks is we have had crises and economic fears every couple of years, right? For every 3 to 4 good years that we have in the market, we typically have some type of correction, right? So you're going to see, has this ever happened before? Well, just in February, right, we had the Dow crashes 800 points after China makes a shocking coronavirus confession. So we go, oh, this is where it's hyper-focused. Now, you could say this time it's different. We've never had anything like this, and that may be true. But back in 2009, we had the swine flu. And maybe we weren't as in tune to it. Remember, we'd laugh at somebody that was in the airport that might have been wearing a mask. And we'd say, oh, what are they worried about? And maybe we weren't as up to date on how serious flu could be, right? But then we had the avian flu just in 2016, right? We had an outbreak of that. And then we had Ebola. Remember that in 2014 and all the stuff that was coming on. And all of these things, these events, they've happened before. And the market doesn't like bad news. So you'll see here that when these announcements were made, so we'll take SARS in China, right? We'll have swine flu from Mexico, Ebola from Africa, and Zika from Brazil. Notice that the dark blue line, this was the crisis at the peak, so the losses. But then you notice within a month that the market typically corrected. Then 3 months, and in 3 of the viruses, it's corrected significant. Now, I don't know what's going to happen this time, right? There's a lot of different opinions, but that's exactly what they are, opinions, right? We don't know what the market's going to do. So to try and react or time the market typically is not a good plan. But what I do want to counsel is that, you see these announcements and you see something like market rout. Well, that's what the news agencies feed on. This is how they make their living. They are there to drive emotion. The news organizations count. I've talked about it the last couple of weeks. I can pull up my apps on my phone and look at what the Dow is doing. And there's a headline like, market soars on virus cure, or, oh my God, tension is with China. I mean, it's every day, it's a pendulum of announcements, and that's what leads to the volatility. And my point is, a lot of times, is that we don't want to feed into this hype or this anxiety or these emotions that we're being handed to endlessly. Now, I'm not saying you shouldn't listen to the news, right? But we have to remember, when you see and you hop on CNBC and you see all the indicators are all red, it's such a minute, it's like a grain of sand on the beach in the spectrum of time. We cannot focus on that one grain. You have to be able to take a step back and be able to see the beauty of the beach, or see out into the horizon and go, okay, where are we going? And what's the best path to get there? Because there's going to be hills and valleys and waves and corrections. I mean, these things are part of the environments that we're in. The MSCI World Index, MSCI is an independent research firm. And what this chart is similar to the chart I showed 2 weeks ago when I was showing the dollar for 150 years, all the places or the events that had happened with that dollar. Well, this time is if you had $100,000, you started in 1969. Now, I was born in 1964, so this is 50 years ago. And what I want to point out to you is that if you start to look at some of the events, I mean, back then is when HIV/AIDS was first announced, and then you got the Hong Kong flu, and then you just look at, as the market's going up, you just have all these events over time. And then you turn around and, okay, we have corrections, and then, different parts of the world, and the market, it's going up, it's going down. But if you just left this all the way to the end, right? That all these events, all these viruses and medical ailments that would have allowed your money to grow to over $6 million. And the point that, I've said this in the past when I've taught the classes, and what I say here is, if I could teach Americans one thing that you could take away to grow and amass wealth, it's the power of uninterrupted compounding. And this is what I'm talking about. If we just allow money to grow and put it off to the side and don't think about it, just let it grow. Now, it depends on where we are in our life cycle as to how much time we can or have to be able to enjoy that. But it is one of the biggest messages we should be conveying to our youth, so that they, at some point in time, as they go through future corrections or future crises, that they have the ability to provide for their families. So what do you need to do? You need to stay calm. Fight the temptation to think that this time it's different. Get a complete understanding of how your portfolio was designed. Right? So we talked about this guy 2 weeks ago, Warren Buffett, arguably one of the greatest investors ever to live. But what he said was, don't buy or sell on the headlines. As coronavirus puts stocks under pressure. Now, we also talked about 2 weeks ago, so that this was written in February, and then Berkshire Hathaway did their annual shareholders meeting 4 weeks ago, that he has been amassing cash. He's typically a buyer. So when everybody else is selling, he's buying. But if everybody else is buying, he's either in a position to wait and look for value or selling. So just, I said this before, he's one of the greatest investors to ever live. And part of his philosophy is have a strategy, be in the market, and don't just buy the hot tip. So how to vaccinate your money? You got to understand, this is probably going to happen again. When? I don't know. We talked about what's the fall of this year going to look like? What are the economic numbers? What's unemployment going to look like? What happens when the stimulus money runs out? I mean, there's a list of questions that we could ask, and we don't know the answers to. And, something that could turn around, an industry that is not necessarily top and center right now could evolve to being, a household name in the future. Having strategies, not just being a stock picker and saying, I want to be in Bitcoin or I want to be in Tesla or some biotech company, right? That you need to overall say, we need a strategy that allows us to weather the patterns of volatility. So markets like news are markets, and like news are unpredictable. Markets decline can even be more harmful during retirement. This is where, a lot of folks that are on the call are either at, approaching, or maybe even in retirement. And so this is where, again, having strategies will help you to reduce your anxiety. So developing a bucket strategy, I've mentioned this in the past. Buckets are just symbolic of concepts. So if we're going to have a bucket strategy for taxes, remember, we could have taxable accounts, we're going to have tax deferred, or we're going to have tax free or tax favored. Well, then also from an investment standpoint, from an income strategy standpoint, right, our buckets, if I need money right now in the near future, say 1 to 5 years, right, if I need that money today, well, we have to be a lot more conservative with our investment strategies versus if I have a little bit more time until I might tap into that resource, it allows us to be able to take a little bit marginally more risk. But it really, everybody that's on this call today has to understand is different than the person next to you. You have different goals, you have different assets, you have different needs. So all of this has to be looked at from a holistic standpoint and put a plan together. So part of that is, and one of the things I find quite often, we believe in rebalancing. Just having a strategy that includes rebalancing, I think is prudent. Most of the strategies that we use at my firm, they include rebalancing, whether that be daily, whether that be monthly, at a minimum of quarterly. And what do I mean by that? Let's say that, would you agree that if we had a portfolio that you would put together, and at this point in your life, you're saying, hey, I'm 50-50, 50% equities, 50% bonds. And let's say that was the balance of the allocations starting in February. And then the market corrected. Well, the market corrected, wouldn't you probably, logic would dictate that the money that was in the equities is now off kilter, it's lost values, it's more heavily weighted now towards bonds. Well, that I can tell you, I almost every single time I look at somebody's 401k statement, or I look at their IRA statement where they've moved it over to, and they were trying to do it themselves, typically they don't have the resources or the ability to rebalance. It should be, because what you have to understand is that when you rebalance those equities from the bonds over to the equities, you're buying when the stocks are on sale. And that's the advantage of having some type of strategy like a dividend income replacement strategy. When equity prices fall, which they do, but you're in some type of strategy that provides dividends, right? That now you're dividend reinvesting, and that's buying when stocks are on sale. So when the market comes back, the things continue to blossom and bloom. So know your volatility. I talk about this ad nauseum at my classes. I've talked about it in the past, and I just did a training on it recently. But knowing your volatility is akin to, if you have an average rate of return, and we're going to go to the next slide, right? An average rate of return, and let's say, let's say your portfolio was averaging 10%, but you had a standard deviation of 18%. That's volatility, right? So it means that, and just without getting too technical, you have a 95% probability of being within 2 standard deviations. So that means that sometimes your portfolio is going to be 40%, and sometimes it's going to be, plus negative 30%. And can you handle those kinds of swings? And a lot of people that either try and do it themselves or have, 401ks at work have no idea the impact of a number like standard deviation and how that fits into your plan. And I ask this question to clients all the time. If we could achieve a reasonable rate of return, when I say reasonable, 5-6% I think is reasonable in today's environment, but we could lower the risk compared to what you're currently doing, is there any reason you wouldn't want to do that? And the logical person would say, absolutely not. Why take more risks than we need to achieve the same goal? So, John Bogle, founder of Vanguard. You can Google the internet. Vanguard is known for do-it-yourselfers, and you can't find anything negative about Vanguard, right? Low-cost funds, a lot of people do it, and we use Vanguard. I think that this is a prudent statement. And this goes back to what I was talking about is with compounding. Time is your friend. Just be patient, let things bake. Impulse is your enemy. So if we're baking an apple pie and it says put it in the oven at 325 or 350 for 45 minutes, don't go opening the oven every 10 minutes to check on it. Patience. So are you prepared? Bad news is normal. We are going to have, there's more bad news coming tomorrow or next week or I don't know what it is, but it's rarely permanent and it must be planned for. So step 1, create your financial picture. This is prudent. I think more people will spend more time planning for a 2-week vacation than they will for their entire future. So step 2, analyze your plan. What's volatile? What's stable? What's taxable? From where should you pull your money and when? And what's your worst one you're likely to be? A lot of you probably just went through it just now, right? In February or March, right? That's standard deviation. And hey, listen, the portfolios and the risk compared to had you been in the S&P, maybe the standard deviation was 22%, but maybe your portfolio is 12. You got to know what that is, and will it happen again? But if you go ahead and do asset rebalancing, like we're talking about, start to have a strategy, and there's opportunities to have some type of strategy with your current employer at the current 401k. Why wouldn't you take advantage of that? Then make adjustments, right? Good planning is all about factoring in the possibility and impact of bad news. We know market losses are going to happen. How do we react? If we're working and we continue to contribute into a 401k or 403b or TSP, we know that the market's going to come back and you bought it on sale. Higher taxes is something that we have to plan. That will happen, and what are you doing to deleverage the tax time bomb that's coming? And death and disability, right? They're always premature. They're always untimely. Nobody ever wants to die. Nobody wants to get disabled, but it does happen. And what's your plan in place if it does? So Ben Franklin, by failing to prepare, you're preparing to fail. So far, you've discovered health scares are not new. And have not been financially fatal, right? So we've been through them before, and the world hasn't come to an end. Steps can be taken to protect and even capitalize from them. And proper planning is the key to dealing with the unexpected. Bad news is inevitable. If you learn just one thing, it's this: you don't have to live in fear. So how do you make this happen? Well, you have two choices. You can go out and try and figure this out yourself. Like I said, I'm coming up on 30 years, and I still study every day, and I learn something new every day. But I know this industry, right? As a financial planner, and held to a fiduciary standard, I take a lot of great pride in helping families to avoid the mistakes I've seen others make. Or you can get guided help to get results quickly. If you have questions for me, please reach out. I'm happy to help, to be your guide and help you to avoid mistakes. But if you were invited here by another advisor, please reach out to them and ask your questions to them, and we will continue to bring this to the field. So who is this not for? If you've already have an advisor outside the Eagle team that you trust 100%, right? So if your brother-in-law or your brother is the advisor, and I understand that. I've been doing this a long time, and I've seen it. And even if they were making mistakes, you just don't try and put a wedge between family. On a scale of 1 to 10, if you're a 9 of 10, if you're confident that you're okay, great. Don't keep us a secret. Continue to educate yourselves. You can't learn less. Or if you enjoy handling all your financial planning needs, right? There's a lot to it, but some folks, when they're retired, they go, I really enjoy this. And if you want to do that alone, but I do promote that if you're typically the one that handles the affair in that household, one of the things I always sort of point out is what happens if something happens to you? Does the other person, the significant other, your spouse, know what you were doing and what the strategies are? So, trying to collect all this information should a tragedy happen is not advised. So if you'd like to reach out to us, what you'll receive, a holistic analysis in all the areas of your financial life, right? Retirement income, investment strategies, tax planning, insurance planning, estate planning. What does it cost? Right now, I don't charge a client to meet with me, talk to me, run a plan, to do an analysis. I could charge, $1,500 to $2,500. I've elected not to do that because what I find is that if I can educate you along the way, you'll ultimately want to become my client, because I found in this industry, it's one of the areas that's really lacking, that most of the big places, your Fidelities, your TDs, your Vanguards, they're not doing this level of comprehensive planning, right? And, to do things like Roth conversions, to have your affairs in order are critically important. So, reach out to us. There's our disclaimer. This is just for compliance purposes, invest assets through AUM, through Retirement Wealth Advisors. And then I want to thank you. I want you to thank the advisor that invited you. I hope you enjoyed it. And if you have any questions, just reach out to us at chris@professionalplanningservices.com. Have a great day.